Well, we have certainly had a week. Over the course of the week, we saw the S&P 500 down 3.23%, leaving us with a drop of 4.88% in 1 month. Overall, we've begun to see doubts in the growth story, and investors seem to be becoming more wary of just how high multiples have gotten. But ultimately, these are just stories, and this is just looking at a week. Perhaps one of the most troubling things in the macro picture right now is just how much uncertainty there is. The Russell 2000 was down 4.27% since the start of the week, and down 9.29% in 1 month, which is really interesting since the multiple expansion hasn't been quite as present there. Although, this could be more indicative of concerns of a broader economic nature. If growth is a concern, then that would be more consistent with seeing a drop in the small caps. Moving over internationally, since the start of the week, the FTSE 100 is down 1.47%. and down 1% for the month. On the other hand, the Shanghai Composite was up 1.33% since the start of the week, and 1.52% over the month. And this has led to speculation as to whether now is the time to begin leaving US equities in favor of international, but I remain dubious of this. I personally hold some international exposure, and I don't mean to suggest what someone should invest in, but some of these moves don't quite seem real to me yet. And I'll elaborate more on the next screen. Since the start of the week, the German DAX 30 was up 1.44%, and this is particularly where there's been a lot of new narrative arising. I have personally moved to hold some German exposure, although I am currently feeling that this is short-term and not a true change in the underlying fundamentals. I personally remain more wary of Germany in the medium term, but I'll elaborate more on that later. And going back over the course of the whole month for the German DAX, we've seen a rise of 5.01% in the index, really making it a top performer amongst developed market indices. Gold continued to rise this week, with the front month COMEX futures increasing at 1.44%. while front-month silver rose 3.33%. This has really been an impressive stretch for precious metals. At the same time, crude oil futures dropped 4.39%. And this was a really interesting move because this seemed to coincide with growth concerns. There weren't really any fundamental supply changes, but as more and more data came in indicating weaker economic prospects, the concern rose that there might not be as much demand going forward for oil. Now take a look at the VIX this month, 47.82% up. That's pretty sizable. Personally, I tend to think that there will be elevated volatility in the short to medium term, and the way that I've been playing this is I have been selling options into the elevated volatility, and this sort of strategy does require a lot of caution. But that being said, this past week has been a pretty good environment for sellers of premium. Looking at our last summary screen, rates dropped slightly on the short end and rose on the long end, increasing the 210 spread over the course of the week. And of course, the ever-present question is, does this really mean anything? The movements weren't enormous. However, this could be indicative that market participants are seeing some economic risk. I don't want to make too much of this, but certainly something to keep watching. We began the week coming off of the meeting. And while it was certainly noteworthy diplomatically, there's one point that I'm really curious to speculate on. At one point, the president said, "It's good that the people are seeing this." And this does raise the question as to whether this was done publicly for this purpose. A meeting like that with real heavy negotiation usually isn't done publicly. So why was this one? And I have to wonder if this was done intentionally to bring the state of negotiations out into the public in order to garner public support, so that the US administration could say, "Look, see, we're getting nowhere, here's why." That in turn could give more political cover in order to be more negative toward the Ukrainian regime. But this was only one piece of a more interesting puzzle. As shortly after and going into this week, we saw Zelensky's visit to the United Kingdom, where there was a much more jovial meeting between the two leaders. It seems to me that the Ukraine project is of extraordinary interest to the British. And of all countries in Europe, the United Kingdom has, for centuries, been the most hawkishly anti-Russia, particularly trying to keep them and the Germans apart. The British have sunk a lot into Ukraine and have shown the most willingness to use their military directly. And what might Ukraine have for the United Kingdom? They have a lot of resources. And this coming off the back of the predicament at the LBMA, where T+2 settlement ended up taking 2 months, making me rather suspicious that they had the gold. While the London Bullion Market Association had been being drained of gold over the past few months, the price continued to rise rapidly, including a very curious, unclosable arbitrage. The difference in spot and futures diverged in a very odd way, reflecting how long settlement would take. US and UK diverged, and that arbitrage did not close, leading to a very curious predicament. Does London have hard assets? And even more curious to this point, the UK-Ukraine 100-year partnership has had some interesting reporting around it. Now, I can't say for sure whether this reporting is correct, but particularly out of Central and Eastern Europe, there are reports that the United Kingdom and Ukraine agreed to a resource deal, one not listed plainly in the partnership declaration. The type of resource deal that hasn't been able to be settled with the US. Now, London as a financial hub is an enormous capital creation engine through the lending of US dollars into the euro-dollar market. The US, post the creation of SOFR, has been separating its US dollar from the euro-dollar market. The British have had a long-standing policy of acquiring collateral from foreign countries in order to continue its banking system. Now, Britain is obsessive about Ukraine, going to desperate lengths. It's not able to get gold delivered without taking 2 months. Meanwhile, their fiscal situation is, well, unstable, mildly. Does Britain have a collateral problem? My bet is very much yes. And over the past year, the British 10-year Gilts yield has risen from 4.065 to 4.603, which is fairly substantial. All of this has made me quite suspicious of the British gilt market, the British government's ability to continue to finance itself, and the British banking system's longevity. There seems to be a lot of trouble on Albion. Moving into Tuesday of last week, the President addressed Congress in what was not the State of the Union, but was the State of the Union. And it was mostly a political event, the stating of the administration's platform, and wasn't overall too eventful. Except this. He did have this. But shortly after was when big announcements came. Tariffs. The announcement of upcoming tariffs led to quite a lot of panic across different sectors and nations. And then we heard from retailers who speculated that they would be raising prices. Over the week, Walmart was down 6.41%, Target down 8.27%, and Best Buy down a whole 10.09%. And financial media, ever quick to jump for an easy story, proclaimed, "This is all tariff fears," and printed the story very rapidly, some written by AI. But I do not find that a satisfactory explanation. No, there are deeper growth concerns baked into the entire world economy. And what are those growth concerns? Well, growth has been largely fake for, since 2011, but particularly in the past few years. Growth has been government spending and illusion, and now the reality is popping up across the entire world. It seems to me that tariffs from the US administration are largely being used as a negotiation tool, and certainly could have disruptive effects in the short to medium term, but that really doesn't quite make sense for all we're seeing. Now, it's my contention that the entire planet has seen illusory growth for the past several years, and now reality is asserting itself. And this brings us back to oil prices, as if economic growth is expected to slow, then it would make sense that demand for oil would drop along with it. And two, with this realization, this has begun to raise speculation that we will see lower interest rates in the short or medium term. And I tend to think that this is a correct assertion. You have slowing economic growth across the entire planet, you have technological deflationary forces, and you see for the first time in decades an actual will to cut spending in the government. Those all add up to lower rates. But let's go back to Europe for a moment. We have seen a new willingness to actually have real militaries and real spends. Now, I don't think this solves the economic problem, but it does seem clear that the global order is shifting such that Europe will have to shoulder more of its own weights, which means more spends. And this has been consistent with what we have heard from Prime Minister Starmer. But it also really can't afford to. And what would you expect to see if there were more spends on tech and military going into the private sector, and simultaneously more strain on the financial health of the public sector, particularly in a collateral-strapped and highly levered economy? Well, that would put a whole lot of pressure on the bonds, and would see a flow into equities. And despite a weak for the FTSE, this has generally been the year-to-date trend. Year-to-date, the gilt yield has cooled off a little bit in the middle of the curve, but over the past month has begun shooting back up. And a weak bond, strong stock is something that I expect to continue in the UK for the short to medium term at least. Meanwhile, in Germany, we see something very similar with the incoming chancellor showing a willingness to have a military again. And remember that thesis of strain on the bonds and cash flowing into the stock market? Well, we saw that the DAX had a pretty good time last week. And how did the German Bunds do? The German Bunds were steady. Oh, no, whoa. Yeah, the German Bund exploded in yield. Now, I tend to think that Germany could be a prosperous and strong industrial economy if it chose to do so. But I don't know when it will do so. It's in a bit of a pickle right now. And the EU isn't really working for it. In the long run, I could see a world where Germany leaves the EU. And this gets to a larger macro question about the reordering of diplomatic relationships and economic relationships. What is the future of the EU? And also, what is the future of NATO? Well, the ruling factions of Europe seem absolutely committed to keep these international relationships alive, but I don't know if they can do it, or at least can do it in the medium to long run. Political momentum is against them. The US is changing its role. The amount of spend that will be needed by the European states is maybe impossible. And the reaction of EU and NATO to try to maintain the current order has been, it looks like, flailing. Take the Romanian election. Outside European forces have done everything they can to make sure that Călin Georgescu does not become the leader of the country. And now there's a mess of court battles, protests, and incredible unrest in the country. Georgescu would represent a departure from the European order and would show the country drawing closer, or at least friendlier, to the Russians. And now the whole situation is just a mess. But I'm just really dubious of how long the Brussels axis can hold on. Without the will of their populations, without constant US support, and without the Eurodollar financial engine, what do they even have? So, for all of those reasons, I am very wary of European investment right now, as this looks like a serious political rough patch, and particularly wary of European fixed income. But let's move over to currencies. Against the British pound, the euro, the Chinese yuan, the Canadian dollar, and the Japanese yen, the US dropped against all of them. Now, personally, for my own investment, I have held currency hedges in my European exposure. However, I mostly removed those currency hedges about a week ago. There are certainly forces intending to devalue the dollar. However, there does seem to be a bifurcation of the onshore and offshore dollars, and I expect that you will see a very different dollar between them. And that means that FX versus purchasing power might not align anymore. My personal conjecture is that for the short term, this will continue, and I will remove currency hedges. However, in the long run, I am still bearish against the euro and the British pound. So just to sum up with a macro picture, gold and metals remain at the fore. Even though flows out of the LBMA have slowed, the need for hard collateral does seem to be much more present in this economic environment than in decades past. I have personally been maintaining gold and silver exposure. Next, the resolution to Ukraine is of enormous importance, not just for the horrific loss of life, but probably for the future of Europe. It seems to me that the UK in particular, and France to an extent, need a resolution in their favor where they can benefit, where they can keep the Russians back and they can have that collateral. And fundamental economic inputs. Also, they're tied up in a whole lot of debt that they absolutely need to make sure gets repaid. Long run, I am bearish against the sovereign debt of both countries. Next, we have European weakness, and they have shown signs that they are going to try to fix themselves, but I don't think they can do it quickly. There are a lot of embedded problems, and a lot does not work, and their political environment is really not in the best spot right now. I think the Europeans, and the Germans particularly, can become strong economies again, but this cannot be done quickly. I think anyone who is expecting the great European growth recovery story is looking way too short term, and this is going to be a very long and difficult process with a whole lot more getting worse before it gets better. Next, we have the breaking growth illusion. Now, my stance is that there hasn't been real growth since 1999, and particularly, it's all been an illusion since 2011. But put that aside, post-2020 has been so absolutely illusory, and it's becoming clear that this is not real growth. The economies are not fixed. I expect that will manifest in markets, and I remain the most bullish on the US in order to deal with it, since the US has stuff, and most negative on countries that are the most dependent on US dollar lending facilities and fiscal stimulus. The new dollar order, the separation of the onshore and offshore US dollar, I expect will be a big picture matter for probably the century. Now, I know it's just about impossible to predict out that far, but this does look like one of those foundational monetary order shifts that happens once in 4 or 5 generations. And that would most likely result in a benefit for the United States and United States banking at the expense of foreign businesses and foreign banking, at least ones that have not set up their own separate credit facilities that are not dependent on this US dollar offshore system. And last, capital reallocation. With such a long period of time with really low interest rates and really cheap credit, capital has gone to places that have become so overblown in multiple expansions that there's really nothing more there. There's no more squeeze. And as the economies around the world, and particularly in the West, shift from giving $1 billion to a guy who has an idea for an app and toward hard assets and real industry, I expect there to be a lot of difficulty and shakiness in that transition, probably a lot of market and economic trouble. But the net result would be washing out malinvestment and moving capital to places that are much more productive in the long run. And that was last week.